Hi everyone, I am Mayank Joshipura and today we are going to discuss chemistry of earnings. Let's look at the physical health of an individual versus financial health of a firm. Both are equally important. To measure or to check the human health, what we are looking at normally are the key parameters like blood pressure, body temperature, hemoglobin, and blood sugar. We look at certain range, acceptable range for each one of them, and then figure out, is there any further problem to look into in terms of the health of a human being. The same is true for the health of a firm. It's important to measure the firm's health in terms of some of the key areas or key metrics that can be measured by series of ratios or the measures that we have developed over a period of time. The key aspects of the firm's health can be looked into by looking at the liquidity, solvency, profitability, and how efficiently the firm is utilizing its assets. Once we know all this, we'll be able to figure out the firm in general is in good financial shape or financial health. Now, it's not very simple. When we look at each one of them in isolation, for example, the liquidity of a firm versus solvency of a firm, it doesn't make much sense because each one of them eventually is going to impact the other one. It's exactly like what we see in terms of chemistry. When we look at chemistry, we know that the water is a compound of hydrogen and oxygen, but it's not just a random combination of hydrogen and oxygen. We know to make water, we need to have 2 molecules of hydrogen and 1 of oxygen. Then only you end up getting water, else you get something else. So it's very important that the firm strikes a right balance between liquidity, solvency, and profitability. And of course, it has to learn how to manage assets efficiently. The firm that can do all this reasonably well, they eventually end up getting a grand success in terms of returning to its shareholders. The suppliers will be happy, the customers will be happy in terms of consistent service to the product service, the products that they are selling of high quality, and of course, all stakeholders are eventually going to get benefit. So how does it work? The motive for any business, of course, is to earn profit. And not only the short-term profit, it's a long-term sustainable profitability of a firm is very important. So it's not that we need to look at only the profitability or the short-term profitability and the quantity of earnings. We also need to look at the quality of earnings. Now, how do we measure the profitability? Of course, we are using several profitability ratios where the numerator is some form of profit measure and the denominator is, of course, some form of investment that we made in order to earn that profit. So the popular ratios that we normally use in accounting and a financial statement analysis are return on assets, return on investment, return on capital employed, and return on equity. The ratios vary in terms of the measure that they use for the numerator in terms of measuring profit and the way it measures the investments, whether it belongs to shareholders only or it measures shareholders' investments only, or it also includes the funds provided by lenders and so and so. Well, that measures what is the profitability of a firm, the return on equity, return on investment, return on asset. It's also equally important to figure out what drives this return on investment, so that what are the key drivers that lead to the performance that we are seeing in terms of profitability of a firm. The first such effort, which has been quite popular since then, was made by the firm DuPont, as we know that model as DuPont model way back in 1912. They first tried to sort of decompose the return on assets into its 2 components, the profit margin and asset turnover. Now, that's quite simple. If we look at the return on asset and use the basic formula for that, that's say net profit divided by assets, or you can say net income divided by total assets. If you try to manipulate this, you can come up with 2 different or distinct components. One, what we refer as net profit margin, which is measured by the net income by sales or profit after tax by sales times sales divided by assets. That's nothing but asset turnover. Now this is interesting. The return on asset basically is a profitability ratio. If you look at net profit margin, it's a profit margin ratio times the efficiency ratio, which is asset turnover. Now this looks quite simple, but it's very interesting. What drives your return on asset? For example, let's say there is a business which earns net profit margin of say 10%, but it churns its assets, or it sort of makes twice the sales to the amount of money that I've invested in assets. The 10 times profit margin times or multiplied by 2 times asset turnover, which means the return on asset is 20%. The profit margin is 10%, but the same assets are used to generate sales that is twice as much as the amount of money invested in business. Now this is interesting. The firm, to start with, can opt for one of the two options. Either you go for a high profit margin and a low turnover business, or you go for a low profit margin business but a high turnover business. Now how does it work? Well, it's simple. If you are a manufacturing firm and you bring your raw material, process it at each stage and convert into finished goods, and if it's a complex product, let's say a construction project, it takes a lot of time for your raw material to get converted into a sellable product. And that too, you may end up selling at some credit to your customers. It's not that they're going to give you cash right away. So in that sense, it takes a lot of time to finish this entire cycle, and the amount of money that remain invested both in form of fixed assets as well as the working capital needs, which essentially is nothing but the current assets or the amount of money blocked in current assets, is a quite significant amount. And therefore, the turnover, that is the sales divided by amount of assets that you are invested in, is not going to be a very large number. The asset turnover or the churning of funds may be slow, but that doesn't matter. Since I'm adding value at each stage, right from bringing raw material all the way up to selling finished goods, my margins could be better. So you may have a business which may be capital intensive, which is quite complex. It takes a lot of time, but that doesn't matter. What eventually happens is, since you have added so much value at each stage of this business, you are going to add a lot of value, and therefore you can sell that product or service at quite significant margin. So this is the type of business which is typically a manufacturing or a complex manufacturing firm may look for a high profit margin, and they're okay with low asset turnover. Now on the other end, if you look at the trading business, now trading where you don't add value at each stage, what you do essentially is you just buy finished good from somewhere and sell it eventually to the customer. So you're not bringing raw material and then process it and do a lot of things with that. It's simple. You just go, get that goods and sell it to someone else who needs that one. So well, the margin could be very less, maybe 3%, 4%, doesn't matter. If I churn my stock or inventory for say 5-6 times in a year, I end up getting 4% times 6 or 4% to 6 times a year. So my return on investment or assets eventually is going to be about 24%. Now there's a lot into this. In the beginning, the firm can make a choice whether to go for high profit margin business or high turnover or high churn business. If we look at traditional business models, if we go a little further into this, I'm talking about some of the popular business models in say Western India. So there's no such kind of watertight compartments, but if you look at the way the businesses were conducted over a period of time, let's say you look at a Gujju Banya community, which essentially is a traders community, but they are a sort of shrewd traders community. What they do is, or what they used to do rather is, they'll kind of buy products or goods when the prices are low in the market, the supply is high, and then to stock it for a very long period of time. They don't mind incurring the cost in terms of blocking money to stock it, and the asset turnover may not be very high, but they'll eventually sell it in the market at the time where everyone needs that. So you can sell it at a right time and earn huge amount of profit. So margins could be very high. If you sell something worth 100 rupees, you end up getting, let's say, 10%. So 10% is your profit margin. Even if you churn your asset twice in a year, or if you have sales which is twice as much as assets in the year, you end up getting 20%. So it's the choice that the businessman has to make, is whether I want to earn high margin and I'm okay with low turnover, or there's another community. Again, as I said, there are no watertight compartments, but the Sindhi community, the business model was very different. What they believed is sort of churning goods as fast as possible. And you are okay with low margin. So if the stock comes, you sell it off. Even if you earn low margin, doesn't matter. You are okay with not 10%, you are okay with 5%. But you want to churn the stock 4 times in a year. Now, what has happened over a period of time is something very interesting. And everyone, therefore, has to learn how to continuously sort of keep on changing as per the requirement of the changing business environment. Let's say in old times, where it was okay when people didn't have too many choices, but let's say there are 2 shops side by side. One is run by someone who is looking for a high profit margin and okay with low turnover. The other one, who is also interested in running the same business, is following a very different philosophy. Wants to earn wants to achieve high turnover, it's okay with low margin. Now what happens is, since someone is selling stuff at low margin, may end up getting a lot of footfalls, end up selling a lot of goods, and in today's times, when the risk of obsolescence and change in preferences at the customer's level is very high, stocking goods to earn a huge margin by selling it at a right point of time may not be a great strategy. So you have to churn your goods fast and maintain a low margin but a good turnover. So these are the 2 popular strategies that one can follow. And of course, with changing times, you'll have to ensure that you are doing a good job at both. Now, is it possible? The answer is yes and no. It's not easy, because if that was so easy, everyone can do it. Now, what happens essentially? If you look at today's business environment, it's very competitive. So it's very, very difficult for anyone to sort of just simply push margin on the higher side. So forget about increasing margin. The maintaining net profit margin itself is a huge challenge. So then what you have to do? Well, you have to do in terms of improving your utilization of assets, which means you need to have asset light business, and you will have to sell a lot using the small amount of money blocked in assets. But that is not possible. Your business may not allow you to do so. Now, is it still possible to achieve? The answer is yes. If you look at the second term, that is the asset turnover, it's sales divided by assets. Now, it's not just the efficiency ratio. Within that, you can see there's an element of working capital management as well. Because what happens is, when you look at assets, you know, in a business, you have 2 major types of assets. The long-lived or fixed assets and current assets, which are in form of your working capital requirements. It's the money blocked in receivables, the inventory, the cash lying for the operating purpose, and so on. And while it's not easy for a firm to change its fixed assets in short period of time, it's very much possible to work a lot towards managing current assets better. Now remember, each business may have its own compulsions. It's not very easy that you just go and say, okay, from next day onwards or tomorrow, I'm not going to give you any credit, or for that matter, I'll not maintain inventory. You come to my car showroom, I'll show you catalog. And if you want a particular car, I'll just get it for you. That doesn't happen. You will have to go by industry standards, but within that, there is a sufficient scope to ensure that you manage your assets well, and therefore the given level of assets invested or investments that you have made, you can have the sales, which is kind of going to improve your asset turnover. So essentially, you are looking at how to improve asset turnover. Now, does that mean that you can't improve profit margin? Well, the answer is yes and no. It's not easy, but you can certainly work towards improving profit margin. For example, a firm can look at changing its product mix to shift it towards high profit margin products, and thereby eventually will see an increase in profit margin. So you'll have to think ahead of the curve and the competition, and to ensure that you are doing a good job when it comes to maintaining or improving your margin. At the same time, you don't be complacent. It's not that just to increase sales, you want to give more credits and say, okay, I'll have pile of stocks, etc. It's not going to work. So you have to look at the return on investments or return on assets in two different ways. It's a margin, as we know now, and the turnover, right? So now this is the one level kind of exercise where we talk about return on asset and we decompose that into the profit margin and asset turnover. Now, when we talk about return on asset, or for that matter, return on capital employed or investments, we are looking at the funds provided to run business, both from lenders as well as owners. Now, as we know, owners are shareholders. But eventually, we have to ensure that our shareholders earn sufficient profits over a long period of time. So while return on asset is very important, we are also looking at what's the impact of leverage on our shareholders' return. And therefore, what we are going to look at is the three component ROE analysis. You see, it's not return on asset any longer, it's return on equity. So the first two terms remain same. Is the return on equity. If you look at the drivers of return on equity, that is the net income or profit after tax divided by, not the entire capital, not all assets, is the shareholders' fund. The amount of money that is invested in business by shareholders. Of course, it includes the paid up capital, the initial funds, plus the profits that were plowed back into the business in form of reserves and surplus, etc., etc. So, it's a return on net worth or return on equity. Now there, if you look at the third component, it's interesting. If we further manipulate this equation and we say, okay, I don't want this net income by assets any longer. Now I want net income or profit after tax divided by equity or net worth. Now what do I need to do? The first two terms, as you know, that is net profit margin times asset turnover. That gives us return on asset. So what we are now looking at is adding third term to this multiplication is assets divided by equity. Now, as you know, the basic accounting equation, and it tells you that assets is sort of nothing but the combination of debt plus equity. So this is some form of gearing or leverage ratio, which talks about equity plus debt divided by equity. And now if you look at this three together and collapse it, eventually you get something like profit after tax divided by equity. So what is this equity multiplier? Now in the simplest of form, if I am doing business with my own money, then my sort of multiplier is 1, because my entire set of assets or the entire capital is sort of funded by equity only. I'm not borrowing a single penny from anyone. So in absence of tax, for our convenience, you can say that the return on investment is equal to, let's say, return on equity, or return on capital employed is equal to return on equity. Of course, there are some minor differences that you can use. Well, say return on investment is slightly different than return on capital employed, but we are not going to sort of miss out on forests for trees. So it's not that we are going into those minute details at this point of time. But it's important to understand this third term. The leverage is basically not a finance term, it's a physics term. And as we understand the leverage, the concept of leverage, if you apply force from distance, it creates a lot more impact than the force applied, which means the effort required for desired impact is much less if that force is applied from distance. Now, how that sort of comes into picture in finance? Well, that comes into picture, and let's try to understand that. But remember one thing, leverage, be it operating or financial, it's a double-edged sword, which means it amplifies the outcome compared to in proportion to effort on both sides. It may be positive or negative. So whether to use this high equity multiplier to amplify return on assets and convert into a higher ROE is a complex choice. So let's look at two possible scenarios to understand what's the impact of having this large equity multiplier, large number in excess of 1. Let's say there are two firms in the same industry which has enough scope to expand. And for now, there is no kind of supply exhaustion or anything, or the oversupply situation. So let's say firm A has ROI of 15%. Firm B also has ROI of 15%, because these are essentially identical firms in the same industry, but the business of essentially whatever the amount of money that you invest is going to give you, say, about 15%. For now, we are assuming a simple tax exempt world, or sort of zero tax world for our convenience. And let's say firm A is sort of very content doing business with its own money. It doesn't like leverage. It doesn't like to borrow money. And therefore, of course, it doesn't have to pay any interest for that. So it says we put 100 rupees, our assets are 100, our investment is 100. There's no debt that we are taking. The interest that has to be paid is 0. And therefore, my earnings before interest and tax is going to be 15. And then since I don't have to pay any interest, I don't have to pay any tax, my net income or profit after tax also is 15. And therefore, my return on investment is equal to 15%. My return on equity also is, say, 15%. Let's look at the other situation where, of course, I am using ROI as like EBIT to the amount of money invested. You can use that as ROC or whatever that you want to use. But essentially, what we are talking about is the second situation, the second firm, which also is going to earn ROI of 15%, but it has opted for a different route. Its banker is keen to offer him credit, or the firm credit. So what firm decides is that, okay, I'll invest my 100 rupees, but I'll also borrow money, right? I'll also borrow money, 200 rupees on my 100 rupees, and therefore I'll have 300 rupees to invest, right? And eventually I'll earn 15% on that. So my earnings before interest and tax, or operating profit on my 300 rupees at the rate of 15%, is going to be 45 rupees. Now, will I retain 45 rupees as shareholders? The answer is no. What happens is I'll have to first give 20 rupees out there in form of interest, and what remains with me is just 25 rupees. The 25 rupees remains for shareholder, and therefore, while my business earned only 15%, what I ended up earning for my shareholders is 25%. So my ROE, that is return on equity, is not 15%, it's 25%. What's the difference between firm A and B? Well, the only difference is the firm B has decided to borrow further 200 rupees at the rate of 10% from its bank, and therefore it deployed 300 rupees, 20 rupees were paid in form of interest. The return on equity is 25%. Well, that's a great business. As long as your return on investment or return on capital employed is going to be higher than the cost of borrowing, the firm should keep on borrowing, so that you get benefit of a significant equity multiplier, and your ROA is going to be much higher. If you look at this, the assets or investments in this case are worth 300, whereas the equity is just 100. So the assets by equity, that's the third term in that ROE analysis that we talk, or equity multiplier in this case, is as high as 3. So you lift that in that sense. Well, but that's not a great idea. It's like, yes, 300 rupees worth assets, 100 rupees worth equity. It works really well as long as your borrowing cost is much lower than your return on investment that you earn. But remember, this return on investment is expected going forward. Now, if you look at today's times for that matter, where we are sort of struck by, or we are hit by something like COVID-19, which was not expected. It's even something which is more predictable, that you invest at the peak of the business cycle and suddenly the business cycle turns the other way around. What essentially happens is that everyone thought that they're going to earn 15%, right? But that's not the case. What may eventually happen is that it's just that, okay, you just ignore that scenario 2 part here. Essentially, it's where what I mean to say is that in scenario 2, the return on investment drops to, say, 5% instead of 15%. If you had put your own money, right, the return on investment is 5% instead of 15%. So return on equity also is going to be 5%. So you are going to proportionately come down. So return on investment is 5%, return on equity is 5%, but that's okay, right? Firm B, on the other hand, If it's not 15%, just ignore that scenario 2 here for a while on the slide, right? If it's just 5% return on investment, remember the firm B has invested how much? 300 rupees. And if you look at this 300 rupees that they have invested, they'll earn only 5% on it, which means they'll earn 15 rupees. But they have borrowed 200 rupees as 20%, 10%. So they'll have to return in money in form of interest, which is 20. They've earned only 15. So not only that they'll have to return that 15, they'll have to give 5%, 5 rupees from their own pocket. And therefore, the return on equity is not going to be like 5%. It's going to be minus 5%, negative 5%. So if you borrow money at 10%, your return on investment is say 15%, right? And if you have borrowed twice as much as what you contribute in form of equity, your 15% ROI may go up to 25%. But if your business gives only 5%, and if you still have that 2:1 debt to equity or 3:1 asset to equity, then eventually you are going to have not 5% ROE, but a negative 5% ROE. So it amplifies outcome on both the sides. It increases your ROE if the relationship between the return on investment and borrowing cost is favorable. But if the relationship turns adverse, it's going to hurt you seriously. So when it comes to the third component, that is the ROE that we are talking about, it's not very easy. It's, yes, you can push your ROE higher, but if a firm that has high ROE, which is primarily contributed by increased leverage, it's not about quantity of earnings. The quality of earnings is suspect. Remember, the quality of earnings is suspect. It comes back and really haunt you, as we can see that has been happening for several firms in this COVID crisis. We are seeing several of them who are having large leverage. They are going to find it very difficult to sort of swim through the other end of this massive problem that we have. And those are the ones who are nimble enough. They are not heavily levered. They are going to sail through and eventually benefit out of that. It's not that one should not borrow. The question is, what's the optimum leverage of equity multiplier or leverage that you will have to apply to boost your ROE will sort of decide the quality of your earnings. The last one, it's the three component that we talked about. Now we are looking at dividing this return on equity into further components. So we'll now convert this three-factor return on equity. Remember, those three factors were, or the three components were, the net profit margin, that is a profitability ratio, the return on asset, which is an efficiency ratio, and within that actually there is a working capital management or liquidity management as well, because the amount of assets that, or the money that you have invested in assets, is a combination of fixed assets and current assets. So without sacrificing sales, if you can manage your current assets well, to keep your receivables level low, your inventory levels low, automatically your turnover is going to be better than your competitors. So it's liquidity, it's profitability, it's the efficiency of utilizing assets. And the last one, of course, is the gearing in that sense, or the financial leverage. You can add to your return on equity if the leverage works in your favor, the financial leverage works in your favor. Well, if it's not, then you are going to be in trouble. The last thing that we are going to do is we are trying to further decompose our ROE in order to understand various other aspects of your income statements and balance sheet and how your ROE looks like, or from where your ROE is coming actually. So if you look at this five-factor ROE, it's component ROE, there's nothing different. It's still, if you look at the first item and the last item, it's a profit after tax divided by equity. But now we are looking at several aspects. The profit after tax to profit before tax, the profit before tax to EBIT, which is operating profit, times EBIT to sales, and then our known suspects, that is asset turnover and the gearing or the equity multiplier. Now, what do we mean by this? We look at this, it's very interesting, right? If you look at the first component, that is a profit before after tax to profit before tax. So the only item which is there in between in your income statement, it's earnings before tax, less tax, and then you reach to that net income or profit after tax. Now, how can you have this ratio high? Now, remember, the maximum this ratio can be unless you have some previous credits or something coming in. Generally, it's not going to be the case. The ratio is going to be less than 1. It's a profitable firm. It has to pay some tax. But that's not the case. Some firms may end up paying much lower effective tax compared to others, despite being there in the same tax regime. Possibly, they are having some benefits in terms of the products that they are selling. So they are enjoying tax holidays. They may have some sort of other benefits going on, and that may be true for most of them or all of them rather. For example, in September of 2019, India announced the rate cut in terms of corporate income tax rate or corporate tax rate, and therefore it's possible for firms to sort of pay lower tax than probably what they were paying earlier. And those firms which are in the highest marginal tax bracket, or they were paying highest effective tax rate, they are going to have a much better ratio in terms of PBT to PAT conversion. So the effective tax rate will go down. We are not talking about some more complex issues, but it's very much possible. For example, there are several M&A transactions that have happened in US where, so for example, in Ireland, the effective tax rate is much lower. So some of the transactions, the M&A transactions, were purely intended towards changing tax residency of a firm from, let's say, from US to Ireland, or from a tax, the kind of the market where the tax rates are, effective tax rates are high, to a market which is much lower, or a country which has much lower tax. And of course, the regulators will keep on coming up with ways not to allow this kind of tax arbitrage. They may block several of them, but firms may find those kind of things. But we are not talking about those quasi-legal sort of ways of doing it, but there are plenty of ways. You can have right product mix, the products that the government may want you to produce and you are actually into it, or you are doing something for exports which government may want to incentivize. So the conversion, the lower the effective tax rate, higher the PAT to PBT ratio, and it's possible, but everything else is same. The firm with the low effective tax rate, right, is sort of having an advantage in terms of ultimately higher shareholders' profit. So this PAT to PBT, higher it is, closer it is towards 1 rather than 0, right? And that is a good sign, right? And in that sense, it shows the efficiency of managing tax in a legal way, right? The second term, if you look at, right? So remember, the first 3 terms essentially are talking about nothing but what we have already done. It's like net profit margin. It's PAT divided by sales, if you look at the combination of these 3. But the first term tells you what drives your net profit margin. What is your tax efficiency? The second one is your borrowing efficiency. From EBIT, let's say, or PBIT, that is profit before interest and tax, and this is an operating profit that we talk about, how much is the interest that the firm has to pay? And then you reach to this earnings before interest and or earnings before tax. We are not talking about extraordinary items or other income, etc. In a simple form, it's EBIT, pay interest, you reach to that profit before tax. Now, the amount of interest or the finance cost that the firm will have to incur is, of course, the function of debt the firm is using. But that's not the case. It's possible that a firm with great reputation and ability to manage debt well, or the borrowing efficiency is very good, like firms like Reliance, who can borrow funds at a much lower rate compared to others. Even in this difficult times, as we are going through this COVID-19 crisis, the government of Kerala, before some time, borrowed funds from the market at about 8.96% for a 15 years bond, whereas the HDFC recently could raise funds at just 7.2%. So it's not about the quantum of debt. Of course, eventually, if you borrow too much, the cost of borrowing will go up. Lenders will find it difficult. But if you are a reputed borrower, it's possible for you to raise funds at a much lower rate compared to someone else. And therefore, what you can see here is for 2 firms which are having similar operating profit, that is earnings before interest and tax, maybe similar level of debt as well, but the firm with superior reputation compared to other may eventually will have a much higher profit before tax, or that the conversion ratio in terms of the PBT to EBIT or EBT to EBIT is again closer to 1. So while PAT to PBT shows you the tax management efficiency that the firm has, the PBT to EBIT, or what we say is the pre-tax profit to operating profit ratio, tells you how much of your operating profit is going in terms of paying to your lenders, and lower that number is, better it is, even if for the same level amount of debt the firm is using. The third one is pure operating profit. It's the earnings before interest and tax. Of course, it's not a cash operating profit. You may tweak and use some other ratios. For example, you may want to use EBITDA, or you may want to use NOPLET, that's sort of an operating profit, but on a post-tax basis in a different scenario. But to maintain this, the 5-component spirit that we are discussing at this point of time, it's an operating profit. It's earnings before interest and tax. It doesn't talk about any other income. It doesn't talk about extraordinary items. It doesn't look into the effect of finance cost, because that's not the operating part of the cost that you have in your income statement, or the money that you have to pay to exchequer in terms of the corporate tax. So what we are talking about is the operating profit divided by sales, which is operating profit margin. Now, this is something which is the core for any business. A good, stable, high operating profit margin is a great thing for a business to have. If a firm can increase this, there is nothing like it. There is nothing that is contributed by finance cost or reduction in finance cost. Nothing is contributed in terms of the government action to reduce tax or anything. It's nothing of that sort. It's purely the operating performance of the firm, and that drives sort of this operating profit margin, something which is very, very important. So if your return on equity has gone up because your operating profit margin has gone up, or your borrowing efficiency has gone up, there's nothing like it. Also, as we discussed earlier, it's the sales to assets. We discussed earlier, higher the turnover, better it is. There's a word of caution here. Many a times, it may happen that the firm may be using some very old assets, right? It's due for reinvestment or a kind of replacement. And just to sort of maintain ratios, if I keep that asset base low, right, the chances are there that I may show high turnover, I may show low asset base and higher return on investments, return on assets, but it may not be lasting. Going forward, you may see that it's sort of going to hurt you, because if not this year, going forward, you'll have to make large investment in terms of putting sort of money to replace these assets, or eventually it may lead to quality issues with the product, with this old assets that you have, and then those kind of things. So there are some more granular stuff to that, and you can get into those sort of things. Broadly, firm with a consistent track record, the rest of the things are in line. The kind of investment in terms of capex, which is a maintenance capex, development capex, is sort of ongoing. It's not disturbed to manage earnings. It looks perfectly fine, right? And the last one, of course, we know is the deadliest thing, which can lift your ROE in no time. Just finance your assets, right, using debt, and that sort of makes a lot of sense. So while you are making investments in assets, right, at the right time, it's heavily funded by debt. Now, that sort of may push your equity multiplier. So while return on investment or return on asset is not going to be great, this sort of thing is going to push your the equity multiplier high, right? But that's not a great thing to do as far as the quality of ROE is concerned. So in summary, we can look at ROE and its 5 components. The first component, that's a PAT to PBT, shows how well you are managing tax. So it's a tax management efficiency at the firm level. The second component, which is PBT to EBIT, it shows the borrowing efficiency that you have. The third one talks about the operating profit margin and how well you manage your operating cost and sort of sell your products at a decent margin, right, in the marketplace. The fourth one, how well you are utilizing your assets, your fixed assets, working capital in terms of current assets, and your sales with respect to the amount of money that you have blocked in terms of assets. And the last one, of course, is an equity multiplier, which as we discussed is a double-edged sword, right? Before we close, let's look at this 5-component ROE analysis for a firm, which of course is a great firm as we know, from 1941, Asian Paints that got listed in 1981, and for better part of 3 decades now, it has been undisputed leader in Indian paint industry. What is that Asian Paints has been doing and how to decompose its ROE, that is return on equity, in this 5 components that we have just learned, and to see whether it makes sense. Well, ROE looks good optically, whether the quality of earnings is really good and what drives this, right? So if you look at Asian Paints, and remember Asian Paints in a way is a debt-free company at a standalone level. I'm using consolidated numbers. Also, I'm using total assets. You can always kind of tweak it around and say, okay, we want to use assets less current liabilities because that's what you don't need to fund at all. And what we are looking at essentially is this ROE of 22.79%. Net profit margin, if you look at, is 11.22%. Times asset turnover, which is 1.235 times, and the total leverage, which is equity multiplier, that is assets divided by equity, which is 1.645 times. If it's 2, then the debt equity is 1:1. So Asian Paints hardly uses any leverage at even net level, if you look at, right? Or on a consolidated level as well, right? So if you look at Asian Paints ROE and you decompose into this 3 parts, it's at 22.79%. What all contributes to this 22.79%? Does it earn margin of 22.79? No. The net profit margin is 11.22%. The asset turnover is 1.235 times. The Asian Paints has invested 100,000 in assets. In a year's time, it makes sales of 123.5 thousand in a year, right? And then equity multiplier, of course, it's 1.645 times. The debt equity is roughly, let's say, 0.65:1, which means it's not at all risky. It's not using debt. Of course, the lenders may be keen to lend funds to them, but they generate sufficient internal cash flows to fund its growth. And therefore, it's sort of not borrowing a great deal. In fact, they've made a lot of investments, but we don't get into those granular details. To see some of the other aspects, if you further want to, let's say, decompose what drives this net profit margin of 11.2%, you can see that operating profit margin is 17.16%. It hardly borrows anything. So its PBT to PBIT is just it's about 0.98 or 98%, which means just about 2% is going in form of interest, and PBIT to PBT, which is 65.3%. So roughly they pay about 34.7% in form of tax. And with the tax rate, which is going to go down and they'll start benefiting going forward, you can see that net profit margin may further go up, unless of course they decide or they eventually decide to pass on some part of it to customers. And then you may eventually see benefit in terms of some bit of margin improvement, and some bit of turnover also will go up because the sales will get impacted favorably in that sense. It's not that we are going to look at this point of time what the Asian Paint is going to do or someone else is going to do. But it's important not just to look at the return on equity or return on capital employed or any such profitability ratio for a firm. It's also important to understand what are the key drivers of this and whether the firm has any further leverage in terms of pushing these numbers higher. So with this, we are going to close this video. I hope that you have liked this. If you have really liked this, please comment, give suggestions, and we'll kind of continue talking to you on various such topics going forward.